Reality distortion filters. Deactivated. Welcome to AI Unveiled. Hype versus reality.
Through the labyrinth, where technological promises collide with implementation challenges. Initiating deep dive analysis, subroutines, and activating experiential knowledge databases in 3, 2, 1.
The AI valuation bubble.
Welcome to another eye-opening episode of AI Unveiled. Today we're diving into a critical examination of what might be the most dangerous bubble in tech, the artificial inflation of AI startup valuations. CoreWeave, an AI infrastructure company, is pursuing an IPO at up to $26 billion, despite significant net losses. This is just one example of valuations that appear disconnected from financial fundamentals. After 25 years in this industry, I've seen bubble patterns before, and today, we're dissecting why this time could be particularly concerning.
Section 1. The mechanisms of valuation inflation.
Let me break down exactly how these inflated valuations happen, because they don't occur by accident. What we're seeing across the industry is a deliberate system I call the markup merry-go-round. Venture capital operates on a fundamental principle where the perceived value of investments must increase over time. Each new funding round typically arrives at a higher valuation, allowing VCs to report impressive paper returns to their limited partners. In my discussions with executive leadership teams at several Fortune 100 companies, I've observed mounting concern about another practice sometimes referred to as round tripping. This involves large technology companies investing in startups that then use those funds to purchase products or services from the very same investor. It's essentially recycling money while creating artificial revenue for both parties. And let's not ignore how these valuations get further inflated through strategic ambiguity. AI companies often employ technical jargon and vague claims about capabilities that are difficult for non-specialists to verify. Even sophisticated investors struggle to accurately assess true value propositions when confronted with deliberately obscure technical explanations.
Section 2. CoreWeave Case Study.
Let's examine CoreWeave as our primary case study. It represents perhaps the most visible current example of potentially inflated AI startup valuations. Their IPO preparations outline a target valuation of up to $26 billion, a staggering figure for a company that reported a net loss of $863.4 million, despite revenues of $1.92 billion in 2024. Founded in 2017, CoreWeave has positioned itself as providing access to data centers and high-powered chips for AI workloads. The most concerning aspect? Microsoft accounts for 62% of the company's revenue, $1.2 billion in 2024. This level of customer concentration represents an existential risk that would typically warrant significant valuation discounts rather than premiums. Another red flag is CoreWeave's relationship with NVIDIA, which has invested in the company. Industry observers have speculated that NVIDIA's investment in CoreWeave, which was immediately followed by CoreWeave's purchase of NVIDIA's H100 chips, could effectively represent fabricating revenue through a circular financial arrangement. A recent client faced similar challenges, with investor expectations for growth, but on a much smaller scale. When we analyzed their customer concentration metrics, we discovered that 40% of revenue came from 2 customers. In traditional valuations, this would create significant downward pressure on multiples. Yet in today's frothy AI market, these fundamental risk factors are being overlooked.
Section 3. Broader AI bubble indicators.
CoreWeave is far from alone. The broader AI investment landscape has seen startups reaching unprecedented valuations that appear disconnected from traditional financial metrics, creating what many analysts are calling an AI bubble. Based on my 2 decades of experience evaluating technology investments, I see striking parallels to the dot-com bubble of the late 1990s. During that era, internet startups with minimal revenue and no profits commanded massive valuations based on speculative potential rather than demonstrated business viability. Today's environment shows similar characteristics: excessive enthusiasm for transformative technology, focus on growth metrics over profitability, and valuations based on future potential rather than current performance. Consider this sobering example. Chinese startup DeepSeek recently announced it developed an AI model outperforming American competitors at a fraction of the cost, spending just $6 million compared to billions by US companies. This sent shockwaves through the market, causing a $1 trillion rout in AI-related stocks in a single day. This dramatic reaction demonstrates the market's recognition of the fragility of current AI valuations and their vulnerability to technological or competitive disruption. In working with investment committees across multiple organizations, I've observed a disturbing pattern of justifications for these valuations, with terms like revolutionary potential and paradigm shift being used to wave away fundamental business metrics. These are the same phrases I heard in 1999 and 2000, before the dot-com crash.
Section 4. Consequences and predictions.
The artificial inflation of valuations creates serious risks, not just for direct participants, but for the broader financial ecosystem and innovation landscape. History demonstrates that valuation bubbles eventually correct, often dramatically, and with significant collateral damage. The longer artificially inflated valuations persist, the more severe the eventual correction tends to be. When that correction comes, whether through failed IPOs, down rounds, or outright bankruptcies, the consequences extend far beyond professional investors to impact employees holding stock options, retail investors who bought into the hype, and the broader innovation ecosystem. Perhaps the most subtle but significant consequence is the distortion effect on innovation priorities. When companies are rewarded with massive valuations for pursuing certain technology directions, regardless of profitability or customer value, it creates powerful incentives that redirect talent and capital toward hype-driven rather than value-driven innovation. As we look ahead to the third and fourth quarters of 2025, I believe we'll see the beginning of this necessary correction. CoreWeave's IPO may indeed be the canary in the coal mine, either validating these astronomical valuations or triggering a reassessment that ripples throughout the entire AI funding ecosystem.
Actionable takeaway.
For investors, executives, and technologists navigating this landscape, I recommend 3 specific actions. First, double down on fundamental analysis. Regardless of technology hype cycles, businesses ultimately succeed based on sustainable competitive advantages, diversified revenue streams, and paths to profitability. Second, resist FOMO-driven decision-making. The fear of missing out has led many sophisticated investors to abandon sound investment principles. Patience will likely be rewarded as valuations inevitably reconnect with business fundamentals. Third, prioritize value creation over valuation. For startup leaders, focus on building sustainable businesses that deliver genuine customer value rather than chasing the next funding round at any cost. The AI revolution is real and transformative, but that doesn't mean every AI company justifies a multi-billion-dollar valuation. By distinguishing between genuine innovation and financial engineering, we can better identify where sustainable value will be created in this remarkable technological transition. As always, I'm Asif, helping you navigate the signal from the noise in artificial intelligence. Until next time, stay vigilant and follow the data, not the hype.
Analysis cycle concluded.
AI Unveiled is produced by nxtg.ai. For AI strategy consulting, visit nxtg.ai or connect with me on professional networks. Subscribe to AI Unveiled on all major platforms and join our community of forward-thinking leaders navigating the AI revolution.